Hello.
Yes.
Sir, സാറിന്റെ സ്ലൈഡിൽ ഒരു ഇതുണ്ടായിരുന്നില്ലേ, വൈ ട്രഷറി പ്രിഫർ റിപ്പോ ദാൻ CD എന്ന് പറഞ്ഞിട്ട്, അതൊന്ന് എക്സ്പ്ലെയിൻ ചെയ്തരോ സർ.
വൈ ട്രഷറി പ്രിഫറൻസ് അല്ല, രണ്ട് ആൾട്ടർനേറ്റീവ് ചോയ്സസ് ഉണ്ടെന്നാണ്.
വൈ പ്രിഫർ മോർ
അല്ല, ദാറ്റ് ഈസ് ഒന്ന് മാർക്കറ്റിൽ നിന്ന് ബോറോ ചെയ്താൽ ഇറ്റ് വിൽ ബി ബോറോയിങ്, ലൈബിലിറ്റിയും കാണും, ക്യാഷ് വരുമ്പോൾ അസറ്റും, രണ്ട് സൈഡും നമുക്ക് ബാലൻസ് ഷീറ്റ് കൂടും. മറ്റേതിൽ ചെയ്യാനാണെങ്കിൽ ബാലൻസിനെ അഫക്റ്റ് ചെയ്യില്ല, ഇൻവെസ്റ്റ്മെന്റ് എസ് കുറയും, ക്യാഷ് ബാലൻസ് കൂടും. രണ്ട് വേസ് ആണ്, അത്രയേ ഉള്ളൂ. പ്രിഫറൻസ് ഇല്ല, ബാലൻസ് ഷീറ്റ് ന്യൂട്രൽ ആവും, അത്രയേ ഉള്ളൂ. ട്രഷറിക്ക് amount that will be raising so many ways, depends upon that will be varying second to second, every minute that varies, because funds liquidity position will be changing. If you are short of funds, borrow cheyam, surplus security anengil you can sell off the security and raise fund. So many ways are there. But suppose a temporary shortage anengil security vittal nashtam, you may have to buy again, then we will go for the borrowing. So everything is, we will do that costing. Treasury, because the amount also is very huge, immediately they will do the costing, because everything is, the computer will be in your fingertip, figures are there. So at what rate you have to sell to break even, what rate I have to buy to get that current deal, everything is possible through the machine. Feed the data, within fraction of a second you will get that. Okay, because the amount will be huge. All interesting ആണ്, because നമുക്ക് unfortunately പറഞ്ഞ ടൈമില്ല, otherwise we can. 5 വർഷം ട്രഷറിയിൽ ഞാൻ വലിയ സാറ് വർക്ക് ചെയ്താണ്, ഹാൻഡ്സ് ഓൺ ആയിട്ട് തന്നെ. ഫോർച്ചുനേറ്റ്ലി വി ഗോട്ട് എൻ ഓപ്പർച്യൂണിറ്റി. സോ മെനി തിങ്സ് വി ഹാവ് ടു ലേൺ. അയ്യോ, ഇൻട്രസ്റ്റിംഗ് ആണ്. യു എക്സ്പ്ലോയിറ്റ് ദാറ്റ് ഓപ്പർച്യൂണിറ്റി. Only handful people get the opportunity to learn these swaps, everything. Can we start? Okay, we'll start. 83. Okay. So dear friends, welcome back. So thank you for immediately coming. I really appreciate again your wonderful response. So derivatives. In the derivatives, so many persons were asking what is option and all. So there could be definitely more question on it. So we will spend time more on it, definitely. As the very name derivative suggests, it is derived from something. That something is known as basic underlying, and this is derived from that. That is why this is known as derivative. It is actually this is just like a contract. Derivative is a contract, financial contract. I will tell an example. A person has booked a forward. Why it has booked? This is a derivative. Why he has booked a forward? He has got an export order, say after 2 months. There is a risk involved, exchange risk involved. We do not know what will be the price after 2 months. Whenever we call it a risk, we have to do, a tool should be there to hedge it. A tool should be there to mitigate it. And forward is the mitigating tool for hedging tool, which we call derivative. And derivative that does not have a stand on its own. It is totally dependent on the basic underlying. If the forward contract is cancelled, that goes. Naturally, there is no point in the derivative. What's the forward? We have to cancel it. Yesterday we have seen in the problems that theoretically problems also we have seen that you would have worked out. Whenever a cancellation happens, naturally this has to be cancelled. Another example is, you see, this is a forward rate. How you compute that? Spot plus premium, say example 2 rupees. 83 spot 83 plus premium 2 is equal to 85. Can you tell me what is the derivative? You can put it in the chat box or tell me and unmute. Hope now the screen is visible, no?
Yes, sir.
Yes, sir.
Okay.
Sir.
Can you tell me in the forward? Now you have to tell me. I have to explain. Think and tell.
Premium.
Hedge. No, my question is, you understand the question
Premium.
here? What is the derivative? Is it that forward rate is a derivative, or spot is a derivative, or premium is a derivative?
Forward rate.
Premium, sir. Premium.
Forward rate.
Forward, sir.
Forward
Forward.
Forward is the
Spot plus
derivative.
premium, na?
Forward is the
Forward
derivative. It is derived from the basic underlying spot. So spot is a basic underlying. This is derived from that. If suppose my spot just changes, that is why if my spot changes to 84, my underline will also change to 86. So this forward, which is a derivative, does not have a stand on its own. When the spot changes, this also will change. This is an example. I got it. So that is why I asked the question. Then
So
derivatives
can
are
forward rate will be changed if a spot rate change.
yes, that is I am changing. I am changing. I have changed. You can see
But
the
when the bank fix it, so that will be fixed on already what is fixed.
you see that is when you are booking that is fixed. Before booking, another person comes that changes. You book it at 86. I come after 1 hour. My rate will not be the same. That is what we mean.
Okay. It will be booked for me, but not for
Okay.
other person.
Other person. That at that point of time, you are
Okay.
going and booking at 10:15. Shubha Muhurte, you are booking 10:15. That forward will be applicable only for you at 10:15. Suppose you are okay, I will decide and come after 1 hour, that rate will change. Got it? You got it? Right.
Yes, sir.
Right. Yeah. Then there are derivatives are two types. One is OTC. OTC is a market, dealer market, or that is over the counter product. Basic, there are two different products. One is OTC product. There the derivatives common are forward, option and swaps. In exchange traded is futures. Basically, the difference between three and these are only the basic difference between OTC product and exchange rate product. What I am meaning is, whatever is the difference between OTC product and exchange traded product, the same is the difference for forward and future, option and future, swap and future. So symbol, I will explain. OTC products, example, forward. You just think about the forward. Now you have understood about the forward very well. That forward, that will, I showed you it is customized. That's an important thing. You come to me, the rate is fixed. You say, I will say 86. Okay, you agree. No, sir, I would like to have some competitive rate. Depends upon you, the volume is more. I will adjust it in my commission so that it is attractive. Period, 1 year up to 13 months, it will be changing. You want for 9 months, I will give for 9 months. You want for 3 months, I will give for 3 months. That is customized. So rate is customized, period is customized, amount is customized. You want for $100,000, you want for $1 million, whatever it is as per. So it is customized. So a bank is doing, OTC is a dealer market, dealer. There it is customized. The amount is customized, rate is customized, period is customized. That is a difference. But in exchange traded, what happens is the stock exchange will determine the time. They will say, next month 100 quintals or $1,000, whatever, any commodity, rate also they will fix. It is not customized. Exchange determined. So that is the difference between OTC and exchange. And the forward, you know what is a forward. And the option is, forward is a commitment, obligatory, whereas option is a right but not a commitment. It is not obligatory. It is a right. Anytime if you want, you can do. Otherwise, you can. Example is, somebody has booked a forward for say after 3 months, 84 rupees is the rate. That you have got, you will get $1,000 after 2 months. So you have booked a forward. So 84 is the forward rate. Say the period is next month, December 31st, we will proceed. So December 31st, whatever is the rate, you will get 84,000 rupees because this is a forward rate. This is permanent. But suppose at that market, December 31, the market is 85. There will be a question, what is the loss? Or option A, loss 1,000. Option B, no loss, no profit. What will be your answer? I will tell the question once more. Possibility is there. A customer has booked a forward for ending fixed date delivery December 31st at $84,000. On the 31st December, the market is at 85. This is a forward. Can you tell me what is the option? Is it a loss or no loss or a profit?
This
Sir,
is
no
purchase,
loss.
sir. Sir,
No
purchase
loss,
contract or
Profit.
sale contract,
No loss
sir.
for the customer, sir.
Sir, contract purchase or sale, sir.
Dollar purchase. Forward purchase. $1,000 purchase.
Purchase profit, na, sir.
Loss, sir.
loss.
Loss,
Okay.
okay.
Right,
Sorry.
right. I will tell.
Profit.
Derivatives. Again, I am just inviting your attention to the risk management. I think you have risk management, you have to bestow more attention. Risk management is to protect you against the possible losses. It is not for speculation. It is not for making profit. This forward is booked to ensure that you get 84,000 rupees irrespective of the market. The market is today 85, so it is not a loss. The booking of a derivative is not for making profit. It is a hedging tool. Suppose the market is 83, how much you will get? 84,000. So whatever is the market, derivative once you are booking, you should not look at the market. You will get, even if it is 83 or 80. Please mute. So that is the point. Because merely because it is 85, you should not. The booking of a forward, there is no loss, no profit. You do guaranteed amount you will be receiving. So the question of no loss. And what do you call this cost? This is known as the opportunity cost. This is the opportunity cost. That's all. That is why I have written 1,000 rupees. There is no loss. So derivatives is an instrument. Again, it's concentrate on the risk management, that basic factors underlying. It is a tool to hedge your risk, protect you from the possible losses, downside potential. Again, you should not look up this. The market will vary 85, next 86, next time it may be 80 also. But even then, whatever rate. So that is why we call that as a hedging tool. It will be protect you from the possible losses. But when the market is 85, your attention has gone to 85. So if I have not booked this, I would have received 85,000. That is why your mentality goes natural. Everybody thinks like that only. But on the same time, being a banker, since you have also completed the risk management, why you stop with the thinking, why not the market be 83 or 80? In that case also, you will get 84. And suppose customer insists, no, sir, if the market is better, I will go to the market. Then you go for the option. Never go for the forward. But forward is obligatory. But option is a right. If you want, you can do. But if you don't want, it is not obligatory. The market is good, you will go to the market. So that's the basic difference between the forward and option. Swaps, already I have to say, purchase and sale. It is for adjusting the gap. It is for adjusting the gap. And the futures, it is customer, it is exchange determined. I told you, the exchange, stock exchange, you will fix that. So basically, that is the difference.
Can you explain swaps once again, sir? Just like
Swap is a buy and sell with two different maturities. That is, I am buying the spot. I am selling, buying at spot and selling forward after 3 months. That is a swap. Because I am getting a currency now, which I require only after 3 months. So I will sell the currency now and buy after that, buy at that time, so that will match. Let me see that. Swaps we will take like that. Finally, if time is there, I will we work
Also,
on it.
buying and selling happens, no, sir?
What?
Sir, in arbitrage also buying and selling happens.
No. You just
Buying and selling simultaneously, no, sir?
simultaneously in two different markets for the purpose of making profit. This is also a buy and sell, but it is not
Gap.
different maturities. This is
This is
not for
gap,
the
sir.
profit. It is the purpose is different.
So
So
please,
this is for gap, na?
Huh?
This is for filling the gap, na?
Gap means
Swap.
you want to explain. Gap is the
No,
obligation.
swap is for gap.
Yes, gap management. Yes, swap is for gap management.
so please
Swap is for gap.
explain once again, please. Futures.
Futures is exchange determined. That is, in future you are going to execute a contract. We have not completed. We are going to describe only, no problem. Swaps, if you have got, let me see. If you got that in the afternoon, I'm for making some questions. That is not making that from the text only. I will be asking next time, but depending upon our how that interaction is going, depending upon from the text, I will be asking the questions. And time is there, we will discuss more on swaps. For the time being, study like that, because if you just stop and go to that, you will not be able to complete it. But finally, for the time being, swap you study like this. It is also a buy and sell, but it is not for the purpose of it is for gap adjustment. Because I require the fund at a later date. If I am getting earlier, I will swap it. That is swapping, cross currency swap. We will come to it, no problem. And OTC derivatives, this is a forward. So these are all the different. This is offered by banks. Amount terms are decided by that is the customized. Price is quoted by the bank, adding a margin. The forward already you would have done the problem, adding the margin. Security at bank's discretion, because there is a counterparty risk is there. This is very important because you're doing with the client, merchant. So the counterparty risk is there. If it doesn't deliver, then you have got an obligation to commit. Then profit or loss will be there, which we will be passing on.
Sir,
Settlement
when we use counterparty, it is for bank or customer?
Counterparty is the customer.
Okay.
The bank is doing this forward with a customer. That is why we say that if the customer does not turn up, it is a counterparty risk. Okay. The settlement mostly by physical delivery. But whereas in the exchange traded future, it is organized. Exchange will do it. It is a standardized product. It will not tune it. They will say 100 quintals of wheat or 100 tons of sugar or say $1 million. Like that, whatever be the commodity, it is a standardized product. That amount of contract, the period contract amount, that will be fixed by the exchange. Customer cannot alter it. Whereas this is altered, customized. Transparent pricing, because it is with the stock exchange, the pricing is transparent. Here it will be different. It is not transparent. I do a deal with, say, Indian Bank. My rate will be 83.5. Suppose another customer is there, he will be having a lot of business with that. He will be a valued constituent of that bank. He will be having a better pricing. Depending upon the turnover, the bank can decide. Here it is transparent. Exchange will give only irrespective of the person. That is why it is known as transparent pricing. And here it is a daily cash margin. You do not bother to understand. You need not, because it's slightly confusing, but I will explain that. If you don't understand, don't bother, because they will not ask it. But I will explain. Here that it is an American system where suppose I am doing a future, my price is 80 rupees. I say I will take the delivery of some commodity at 80 rupees next December 31st. So that is my future contract. So I will take delivery, I will buy the commodity at 80. So I will keep 80 rupees with me on December 31st. Suppose tomorrow the price becomes 81. It is a loss for me, 1 rupee loss. I have got only 80 rupees. So what the exchange will give you, or current account will be there, they will put 1 rupee in that. Suppose there is no fluctuation till 31st, exchange will give you 1 rupee. You have got 80 rupees with you. Market is 81. With this 80 and given by that stock exchange 1 rupee, 80 plus 81, you will buy from the market. Similarly, the price has come down to 79. You have got 80 rupees with you. You are prepared to buy that commodity from that future at 80 rupees. But the market is 79. So it's a profit for me on 1 rupee. This I have to give to the exchange. So out of my 80 rupees, 1 rupee to the exchange, with the remaining 79, I will buy from the market. The exchange will go on doing plus or minus in a current account. This is the system. And never bother this. If it is confusing, just leave it. They will not, it's got no relevance with the examination. Question is just by heart. It's a daily cash margin is the way the settlement goes on. That is how the daily cash margin is what I have explained. But at this point of 12th hour, you need not bother for taking too much pain to understand. Here there is no counterparty risk because it is traded with the exchange. Mostly net settlement by the cash. Here the possible questions are, it is that derivatives are customized. That is number one. Here it is exchange determined. Next question can be counterparty risk, can be a question in which the counterparty risk exists in derivative, in OTC, because if it is with a customer, the customer does not okay, and here there is no counterparty risk. And these are the possible questions they can ask. Customized, non-customized, I have answered. And forward, already you know, FPC, FSC, forward purchase, forward sale. It is a customized transaction. I told you, rate, amount, time, customized. Its benefit is, what is the benefit of a forward that you should be able to tell? What is the benefit of booking a forward? Already this much classes are over, you should tell.
Market fluctuation, water.
To hedging risk.
Very only one.
Avoid
It
future
protects
loss.
the customer from, beautiful words are there. It protects the customer. It is fluctuating. I cannot estimate my sales. What will be the price I get? So I will not be able to exactly estimate my profit. But if you are booking a forward, the amount will be determined. It will not change. You will definitely get that amount. Only that you have to execute that contract. So your costing, profit, costing, everything will work out very well. It is an obligation for the customer. Compulsory delivery should be there. Profit bar loss should be, cancellation will result in profit bar loss. That has to be passed on to the customer. Profit bar loss passed on as per the FEDI rules. Early delivery, yesterday we have discussed. And cancellation also is possible. Only that whatever is the start cost will be passed on to the customer. And these are all possible questions they can ask in the examination. What is a call option? Option to buy is a call option. CB is you study like the CB. Call option is buying, and put option is opposite, option to sell. So the call option is to buy. Study like the CB. Call option buying, and naturally put option will be for selling. And two types of option. This also possible they can ask in the examination. American option is a option where you can deliver that refund even before the expiry date, contract date. It is not in practice in India. European option is the option contract should be compulsorily delivered or exercised only on the due date or expiry date or delivery date. In India, we use only European option. These two is not in that much common. Now only it has started. Commodity futures and all options are slowly picking up because it has got so many practical difficulties are there. Because if I want to do it, that we will study that. Plain vanilla option is, that also I will explain later, that is simple without any conditions. An option without any condition is known as plain vanilla option. You study that, that is enough. In swaps, I will explain what is plain vanilla swaps. I will exotic swaps. I will explain later. And the plain vanilla option is just to study that it is an option without any simple option, without any conditions, Otherwise, it will become exotic options. That is not there because too much complications will be there. In India, only plain vanilla option is there. And these are, they can ask in the examination. Option, suppose, I will put an example. Suppose one of you are coming to me. I am the bank. I am the seller of the option. You are coming to me, Mr. A. I will put it Mr. A. Mr. A is coming to me for an option to buy. So I am the person, I am the bank who is going to sell him the option. So it is a call option. So he wants to buy, say, some dollar from me. So that is $1,000 he has come to buy from me. He says that I will buy after the next month, December 31st, I will buy. This is the example. So he has booked a option because he has learned from the earlier expenses. Once he has booked a forward, the market was favorable. He was not able to exploit that. So because of that, he has now decided. So $1,000, December 31st, option, that is option, call option, he is booking. Okay. Here option writer, I am the person who is selling this option. So my name is option writer. He is the call option holder. Suppose you want to sell, it will be sell option. Buy means buy option. Okay. Earlier, because $1,000 that bank was purchasing, here totally different. because the customer want to buy, he will go for buy option. Customer want to sell, he will go for put option. Okay, so he will be the call option holder or put option holder depending upon whether he want to buy or sell. And what is the strike price? Price at which the deal future the option contract is fixed, that is strike price. Expiry date is December 31st. Option premium is upfront. One question will be asked. Why the option premium is upfront? Can anybody tell me? 1,000 rupees I will pay.
Not obligatory option.
Very good. It is not obligatory. Because December 31st, the market is favorable, you will go to the market. It is not obligatory. So that is why I am getting the my premium, my income, my remuneration upfront. Whereas in the forward, it is not required because that is loaded. Commission is loaded in the rate. Then the option premium has two value, intrinsic value and time value. How to find that value? We'll go just to see that example. See, Mr. RK is having a call option. So option to buy a share. That share is at 78 is the strike price. So he is going to buy a share by option at 78. And the option, the strike price, the strike price is 75, and it is traded in the market at 70. So the share he is going to buy from me at 75. Now that is traded in the market at 78, and he has paid an option premium 5 rupees advance. So we have to find out what is the intrinsic value and time portion in this 5 rupees option premium. Intrinsic is simple. Difference between market and the strike price is the intrinsic value. Here the market is 78. My price is 75. So difference is 3 rupees. With the market, the difference is 3. So out of this 5, 3 is intrinsic value. Remaining 5 minus 3, 2 is the time value. This is how we segregate. If the market is 79, can you tell me the intrinsic value and time value in the premium? The market is
4-1.
forward. That's very simple. That's all. Now, another concept that can be asked in the examination is there are 3 stages. We call it at the money. We will first look at the call option. Suppose Mr. A, it is a call option, so he is going to buy from me. So he has booked a strike price is 75. He will buy one commodity. Let it be $1 at 75. If you go to the market also, it is 75. Spot and market are same. It is known as at the money option. This option is known as at the money. Neither profit nor loss. He execute the exercise option 75. He goes to the market also. He can buy at 75. Both are 75. It is his option. He can decide on his own. Normally, he will go for this because already he has paid option premium. And another is in the money is, you go to the in the money spot, market price is more than the strike price. So the customer is benefited because if he is buying, it is a call option. He can buy from me at 75. I am the option writer. If you go to the market, he has to pay 78 rupees for the same thing. So in the market, he has to pay more. So he will exercise the option because it is beneficial. So that is known as in the money option. So in the money option, strike price will be less than the market price, or market price will be more than the strike price. And this is ulta. Out of the money is, you go to the market, you can buy at 73. You come to me, you have to buy at 75. So you will not exercise the option. So in the out of the money option, customer will not exercise the option. In the money option, customer will exercise the option. In the at the money option, it is neutral. He can decide on his own. If it is option to sell, first one is the same. Here it will become ulta. If I want to sell, I will give you 75 rupees. But if we go to the market, he will get only 73. So in the money option, he will exercise the option. He will sell to me only because he will get more. Whereas if the strike price is 75, market is more, he will go to the market because he will get 70 more rupees there, more amount there. So he will not exercise the option. So this in the money, out of the money will be asked for the examination, and this table you have it in the mind. And here the intrinsic value will be only in this option because The difference between market price and strike price is there only here. Favorable. That is why we call in the money option is the only place where intrinsic value of money will be there. Because difference between favorable market price will be there. So that is a point. Next is,
Sir, out of the money, put option also we can calculate, sir. Because favorable difference
it is
is
not
there.
favorable. Out of the money, you come to me, you will get 75. You go to the market, you will get only 73. You will lose.
No.
You are not benefited because of the market.
Calculate the intrinsic value, sir.
Intrinsic is not there. Minus. So here only whatever that you pay is only time value. The market price should be favorable for you. Here it is not favorable. Then another action. The two examples will make you clear. In a call option, we will see the call option to buy. A, enter into a call option. You buy 100 shares of Tata Motors at 500 per share after 3 months. So rupees 500 per share after 3 months you will buy. This is a call option. Option premium 25 rupees per share you have to pay. So this is option. Call option contract is already over. Now see, after 3 months, the price of the share in the market is 600. So first of all, think whether it is in the money or out the money. It is an option to buy. You can buy from me at 500. If you go to the market, you have to pay 600. Is
In
it
the
in
money.
the money?
In the
money.
money.
So whether the customer will execute the option or not,
He will execute.
he will execute because he stands to benefit. Because he has to pay 600 rupees in the market for buying, but he has to pay me only 500. So he will buy. So what is the profit? So 100 into 600 is 600 into 100 is 60,000. Option amount 500 is 50,000. Difference is 10,000 minus option premium 25 into 100. 25 per share, 100 shares. So net benefit is 7,500. Same thing will we see if the market is 400.
So somebody's mic is open.
I am noting that. Here in the stage 2, what happens is it is 400 rupees. If he can buy from me 500, but he can go to the market, he can buy it for 400. So he will not exercise the option. It is out of the money. Market is favorable. So he will not execute the option. So what is his loss? 225 rupees per share he has paid. 2,500 is the loss for him. Same thing, put option. Same thing. After 3 months, the price of the share is 600. So you go to the market.
So you were saying that option does not lose.
Option?
In option, where customer did not lose, but he does not lose anything.
Who told you? Depending upon the market.
Sir, because if the market is 400, the customer will not buy, so he will always get benefit. But the premium 2,500, he is losing his amount.
That is what I have. Hence the loss is 2,500. That is what I told.
But when you are explaining that time you have said that in option customer never lost the value.
Where I did not do.
Depending
So
upon
the market.
I got misunderstood.
You see here 3 stages you see, madam.
No.
Is it no loss, no profit? Here you can make profit. Here it is a loss. Never it can be always profit. Depending upon the market, it will be in the money or out of the money. So that is the benefit of this.
Sir, that forward.
Sir, that fourth slide, I think, when you say that she is telling, sir, we should not think like a profit or loss. It is an outright.
Right. Okay, right. Okay, I got it. You go by this, that is enough. Because if you go for analysis, the time will be lost. Okay. Now you got now cleared. That is what we want. Now it is clarified. Now we'll go to the put option. Okay, right. It is a put option. Here situation, the market is 600 out of the money. Because you go to the market, you are selling, you will get 600. But you come to me, you will sell only at 500. So you will not execute the option. The loss is this 2,500. Whereas if the price is 400 in the money, because you sell it in the market, you will get only 400. You sell to me, you will get 500. So the benefit is 10,000 minus the premium paid, benefit is 7,000. Here maybe what madam is meaning is, when you compare, when that example I was quoting, that was only to purely make you understand difference between forward and option. Had you gone for the option, the market was favorable 78. There also, if the market can also begin 73, if you have gone for an option, there also the loss will be there.
Sir, please explain intrinsic value and time value of money.
Money has got two values.
Yes.
That is, one is intrinsic. Intrinsic value, difference, the favorable, if the market price is favorable, then that is known as the intrinsic value. Example, I will tell you. I have bought gold at 30 rupees, 30,000 rupees. You have bought gold. Now the market is 33,000. So with reference to the market price, you have got a gain of 3,000. That is the
Yes,
intrinsic value. That is the intrinsic value. So here the market is 78. You are having 75. Difference between market and spot is the intrinsic value. Got it?
Yes, sir.
Right.
Yes.
This is
Thank you.
situation 3. Then forward and option. These are all purely repetition of what we have earlier told. Same thing only. Same repetition. So contract should be executed. Same thing only. And future is what we require. And future or forward contracts traded in future exchanges. Future is an agreement to buy or sell at a particular asset. Future contracts are standardized. That's the main thing that you have to order things. You bear in, because this last, I think last year, 2 years before or 1 year before, they have asked this amount for in a future. What's a contract size was asked in the examination. So have just a glance of it. $1,000, euro 1,000, GBP, all $1,000, $1,000, 1,000 euro, 1,000 pound sterling, JBP 100,000 online. This forward features also same differences again, but do not bother. Swaps. Swaps, I will explain with a simple example. You need not look at it. Here that is enough. A Reliance Industry, they have borrowed $1 million from overseas because the interest was very, very attractive. After 1 year, they have to pay both principal and interest in foreign currency. They have bought $1 million, they have borrowed $1 million. After 1 year, they have to repay in foreign currency 1 million plus whatever is the interest. They will be converting this dollar to, swapping this dollar to rupee. This rupee will be invested in their petrol bunks, in their lanes, fresh shops and all. Customers will be buying the products and paying INR. So Reliance will get only INR. Out of this INR, after 1 year, he has to pay back this 1 million plus interest. Okay. We'll assume the interest is 2 lakhs. Just assume interest is 2 lakhs. Now, can you tell me what is the risk he is exposed to? Now, Reliance exchange rate fluctuation. Exchange risk is for. Now, what he says is, no problem. What I will do is, I have got, say, import, sir. He will tell, I have got an import of some products. I will get $1 million. So this $1 million, I will pay the principal 1 million. And whatever the interest is only 2 lakhs. That interest I will purchase from the market. I will outright buy dollar from the market and pay. Now his risk is reduced or same risk?
Risk is reduced.
Reduced because he has hedged the principal. Principal is now hedged. Principal is swapped. Because the swap means he has got a receipt of 1 million from his exports. That amount he will pay the loan, 1 million. So he need not make any purchase, is not there. No exchange rate. So here the principal is hedged. This is known as P-swap. Whatever that proceeds he received, he swap it for making the payment. Suppose he is not having that much of exports. He has got only an export receipt of only 2 lakhs. That is sufficient for payment of the interest alone. So he will swap that amount to pay that interest. So here I swap is interest alone is swapped. The principal 1 million he has to borrow from the market, exchange rate fluctuation. So this is P swaps, or the principal is hedged, principal swap. If the interest alone is hedged, interest swap. Suppose he has got sufficient export proceeds with which he can easily make payment of 1 million 2 lakhs, then P plus I swap. P plus I swap. Can you tell me which swap protects him 100% exchange risk, currency risk?
P plus I.
P
P
plus
plus.
I.
That is
P
the
plus
question.
I.
P plus I swap. Oh, this is a plain vanilla swap, simple swap. Either principal swap or interest swap or P plus I. Principal plus. Most advantageous is P plus I, because possible question they can ask is currency risk or pricey risk is fully protected in which risk, which swap? P plus I swap. I know. This is plain simple. Either P or I or P plus I. Suppose I say conditional, if the interest rate is moving above this much basis point, above the MIBOR or the SOFIA, I will be paying this. If you are adding conditions to it, we call it exotic swaps, which is not prevalent in India. Exotic swaps are those swaps in which you add the conditions. If the interest rate moves beyond this point, then I will do like that. That was exotic, complicated, that is not prevalent. Only to make you understand the difference between plain vanilla and exotic, I just described. Here, the most relevant is only P plus I. Then, that's the most important thing is the IRS. What is an IRS? Let's see. A customer has placed FCNR deposit for 3 years. The interest is 4%. Now, same 4%, we have created an asset. Why? What is the necessity for me to find a matching asset? Can you tell me? To avoid a dash. When a liability is raised for $1 million for 3 years at 4%,
Liquidity.
I have to find a matching asset for the same period at the same rate interest.
Gap
For
risk.
yes,
Liquidity.
very
Interest
good.
rate mismatch
Gap
risk.
risk,
Gap
match
risk.
gap risk.
Gap risk.
Now the match and gap risk is 0, adjusted. But unfortunately, what happens? I am not getting an asset for, nobody is coming to me for 3 years. Everybody says that, sir, the floating, the problem is it is floating related rate. This is fixed rate. So when I go for the asset, everybody said the floating, now the scenario, the scene is totally changed. The floating rate is going up. Just imagine a floating rate which is coming down. Till 4-5 months, 4 months back, the floating rate last 2-3 years, it was coming down. What we'll do is, we will take, nobody is prepared to take for 3 years because they feel the floating rate will come down. So what they will do is, he will be taking only for 1 year. I don't have no other go, because nobody is prepared. Because already I have got a liability for 3 years, but nobody is prepared to accept the asset or take a loan for 3 years. At last, I find a person who will take only for 1 year, that too at the prevailing floating rate. So 1 year, I have for 4%, I have given this 1 million. After 1 year, I will get 4 from the asset. I will pay off the liability at 4. Here you just ignore the margins, because here we want to understand the concept of IRS, interest rate swap. So that is why I am explaining same rate I am getting. Next year, I asked him, can you take? He said, sir, second year also I will take. But unfortunately, the interest came down to 3%. And the floating rate came down. So after second year, how much he will give? He will give only 3, but I have to pay 4. So I have to pay from my pocket 1%. That's a loss. So from my pocket 1%, from the asset I will get 3 plus 1, 4 I will give. Then finally last year what happens? That the floating rate further came down to 2%. So 2% only I will get third year. How much loss for me? 2% I have to put from my pocket. 2 plus 2, 4 I have to pay. So that now the liability is finished off. 3 years are over. I have paid off. So what is the net loss for me because of this deposit of 1 million? Can you tell me? 3%.
3%.
Or second year nil 4. Second year 3 and 4 1% loss. Third year 2% loss. So out of a liability, I have created a loss for 3%. So why this has happened? Because my asset was linked to floating rate and my liability was linked to fixed. So I thought that if I can swap this floating to fixed, I could have saved this loss. How to swap? That is known as interest rate swap. Conditions for interest swap: the amount is notional. Principal will not be exchanged. It should be notional principal. And we have to execute a ISDA agreement. ISDA is International Swaps and Derivatives Association. One format is there. That should be agreed. And whatever is the difference between, I can go for receive fixed or receive floating and pay floating or fixed. I can go for selection of any IRS. And the selection of which IRS is the most important thing. Here I have written receive fixed, pay floating. Or I can receive floating and pay one interest I have to receive, one interest I have to pay. Which one to receive, which one to pay? The selection of this IRS is the most important thing. Now, in this point of time, the examination is there. Don't strain too much. Just to select an opposite of what we require. We receive floating, so opposite is pay floating. We have to pay fixed here. Go for a receive fixed here. Go for an opposite interest rate IRS swap. Just opposite of what we do. We pay fixed here, so receive fixed. We receive floating, so pay floating. Just opposite of what we do. Go for an IRS. So that is easily selected. Now let's see the difference only we have to exchange between this bank. Now we will rework out that. First year this is 4. This is 4. This is the first year. This is first year. First year 4 and 4. How much I have to exchange? Fixed is 4, floating is 4. So I have just presume I have I executed the IRS with ICICI Bank. So with ICICI Bank, difference I have to pay or receive. Fixed is 4, floating is 4. 4 minus 4 is 0. Nothing. The 4 I will pay to this party. Clean. Next year what will happen? 3%. Second year. Second year. How much? Fixed is 4. I have to receive fixed 4. Pay floating 3. 4 minus 3 ICICI Bank will give me 1%. From the asset I will get 3. ICICI Bank I will from IRS 1. 3 plus 1, 4 I will pay this party. So I don't have any outflow of interest. IRS party has given me the 1%. Now the third year, it is 2%. Third year. So fixed 4, floating 2. 4 minus 2, 2. IRS ICICI Bank will give me 2. I will get 2 from asset. 2 plus 2, 4. My liability is paid off. There is no loss from my pocket. Just we will go one more step. Suppose on that year, 1 year, third year, it is 5%. It is 5%. Floating is 5%. Fixed is 4. Fixed is how much? 4. Floating is 5. I have to pay minus 1. I have to pay ICICI 1% because I have received fixed 4, pay floating 5. Floating is more. So I have to pay ICICI Bank 1%. From the floating, I will get 5. 1% I will pay ICICI, 4% I will pay FCNR fixed. There also I stand protected. So this is IRS SAP. I will be protected. And what is the difference? Yes.
Sir, here ICICI Bank paid to whom, sir? Individual?
Yes. Hello? Yeah.
Hello, sir.
Ask.
Sir, here ICICI Bank to pay whom, sir?
ICICI Bank will make the payment.
Make the payment to whom, sir?
They will give to me because I am the party who has entered into IRS agreement with the ICICI Bank.
Oh, to individual.
To me, I am the bank, because I am the bank who has done the IRS. I am the bank, somebody has placed with me liability FCNR. I am State Bank of India, I have to pay this. So I have gone an IRS with ICC Bank.
Okay, sir. Thank you, sir.
And this is a forward rate agreement, is nothing but a small IRS for one period. There, the 3 years were there. Here it will be only one period, either one year or 6 months. That is the difference. And there will be only single outflow. Only one payment will be there. That is why it is a small IRS, I tell. Here, because it is a payment only one, it is upfront, just like the option. Whatever is the benefit, that payment will be, our interest will be paid upfront before the reset period. Here the reset at the end of 1 year, 2nd year, 3rd year, that is what we call that reset period. Here the reset period, it will be given early. And only one question they will ask in the examination. FRA 2/8, forward rate agreement 2/8 means this 2 is a reset period, beginning of the IRS. It is a 6 months IRS, 6 plus 2, 8 months. 8 months is the end period of the IRS. So initially this is a 6 months contract starting from the 2nd month. 8th month it will be over, period of 6 months. This first 2 will denote the interest reset period, starting period. Second will denote the end period. Suppose the question will be like this. Which FRA a person will select for a 9 months period starting in January. Nine months period starting in January. Starting, say, this month or next month.
9.
and 1/10. 10, because 9 months period, the difference will be the period. 10th on 1st October, it has to be paid. So that is the meaning.
So please once again explain.
That first, just study this is enough. First will denote the interest reset period. Second will denote the end period. Suppose a person want it for 6 months, he will go, starting period also is required. Say if it is from February or 2 months from today, then we will go for 2/8, 6 months bar. Suppose they say that a person want to enter into a FRA 3 months from today for a period of 9 months. Then this will be 3 months from today. So 3 months bar, it is for a period of 9 months. So it will be 12. Suppose a person want to enter into a forward agreement 3 months from today for a period of 9 months. Means 3 months from today. So reset period is 3 months. What is the period? Denote the end period is 9 months. So it will be 12th month, it will be entering. Simple. You do not complicate.
Then 2/8, ending after 8 months means 2/10 varada, sir.
Which one? If it is for 10 months, it is 11. You add that period, that is enough.
So
You add that
On
period.
the screen, that is 8 months referred now, sir. That means 2/10.
If it is for 8 months period, it is 2/10.
Okay, sir.
You add that period.
The slide is 8 months, sir.
It is beginning.
On slide it is given 8 months, ending in 8 months.
Ah.
The slide
Oh,
it is
8.
given ending after 8 months. So that would be 2/10.
Oh,
no,
ending.
sir.
But because the example, everything I put in now after refer to, that is it. Correct. You are right. Because I go on changing after 6 months from this date. Then 2 plus 6. Because I go on changing like this, cell is get distorted. That is, I was showing that example, 3/8 and all. And sometimes I will forget to change that.
Okay, sir. Okay, sir.
That is it. Thank you for bringing to my knowledge. Thank you.
Thank you,
Thanks a lot. Because I go on changing, because merely telling you will not understand. That is why I go on changing this. But after changing, I forget to correct it afterwards. And ending
Then
after 6 months. Okay.
Sir, then the
Whiteboard
end
you
period
can
will
use
also
now,
change.
sir.
What one?
Whiteboard you can use now, sir. This
Man,
won't get
what is it?
disturbed.
Doing all these things is a great thing for me.
Yes, sir. Thank you. Okay, thank you, sir.
Sir, in this 2 denotes the interest reset period and 6 will denote the end period, na, sir?
6 is the period duration.
Okay.
8 will be the end period.
Okay.
Okay. Because earlier nearly 8 years I have been taking classes. So I was more comfortable with chalk, board and all. Now only I got accustomed to this system. So I thought
That's
that this,
great thing,
instead
sir.
of
Thank you,
writing,
sir.
I
Thank
am
you, sir.
taking.
Thank you so much, sir.
Okay, let's see. Then swaps. The swaps already I have explained. P swap, I swap, P plus I swap. This is a plain vanilla swap and exotic swap also I have explained to you. And this is a purely theory only, derivatives and market theory only. And this is what are the FIMDA already I have told you. FIMDA I have told you. And this is what you have to, some question they can ask. Financial benchmark already I have told you, this is a joint venture of FIMDA, FEDI and IBA. And they are the person responsible for giving rates. These are the just example rates they give. Term IBOR, certificate of deposit rate, treasury bills, what is the rate, and that is overnight rates are given. That foreign currency option tenors, all these rates are given by this financial FBI. That's all. Now we will go for the duration and VAR. Okay. Next, we will go to that risk management. Again, also risk, you will be very much familiar with that. We will go through that. The mind and the concept already we have yesterday explained. And same thing, why the treasury is risky. Already we know the point, only that we will just consolidate the point. Because high leverage, the low funding requirement, because of that you do more business, though it is more profit. On the other side, more business means more risk also is there. Operate highly volatile market. That already yesterday we have studied dynamic market. Trading deals are running to more than $6.6 trillion. So highly volatile market. So because of that, what will happen is whatever is the loss will crystallize immediately. So I have made say $1 million. So it is now 83 means 8 crore 30 lakhs. Any fall in the rate, my loss will become immediate within few minutes. But 8 crores I give a loan, it will not become NPA overnight. It will become say SMA 0, 1, 2, SSA, DA1, DA2, DA3, like that it will go. But here within few minutes, anything happens, anything crash happens, any political thing happens, immediately the rate will fall. So that is highly risky because the nature of the transaction is highly risky. And sole discretion of a dealer. I will recall that one Nick Leeson was there. He was a dealer in a Barings Bank. What happened was he took so many positions without making the cover operations. Ultimately, it resulted, though it was giving huge profit, when the settlement date came, the bank was not having fund to settle. The bank went bankrupt because one dealer, Nick Leeson, he was jailed. So the sole discretion of a person's judgment, miscalculation can books losses. Confirmed and irrevocable, even it is inadvertent, you click mine. Honestly, I admit that I have done so many mistakes. I was attached to Forex department, 5 years I worked, because you will be under tremendous tensions and all. At that time, I will be short of funds. I have to communicate to them. Instead of buy, I mistold them buy, sell, like that I tell. I have done $500,000. Instead of buying, I was short of funds. Instead of telling buying, you was asking some other thing. Should I sell? Yes, sell. Okay, wrong. Double effect. Instead of $500,000, I ended in 1 million shortage. So we have to adjust the confirmed and irrevocable transaction. Once the commit, mine or buy you take, it has to be honored. Whatever is the loss, that we have to face it. High value transaction, minimum 5 crores and above. So loss is also magnitude is very high. Loss materials in a very short time because it is a dynamic market. All things are, we know, nothing new, same only. But only from risk angle we are analyzing. That's all. Organization territory, front, back, mid, already we have internal control. Risk appetite already we have discussed. Liquidity risk, mismatch in cash flow, already I have told. Interest rate risk also, interest in cost or fall in interest earnings, because our spread will be negative. That is it. And liquidity and interest rate risk are, there are two sides of the same coin, because the liquidity risk is followed by interest rate risk. It cannot be separated. And interest rate risk has come only because of liquidity risk. Like that, we can put in different ways. Currency risk is adverse movement. And interest rate is a domestic cost of currency. Exchange rate is the external cost of currency, the price that you pay exchange for the foreign currency. And VAR, value at risk. Hope that everybody know value, what is value at risk, but even then I will explain with a simple example. This is the best example. The worst possible rate for an exporter or an importer. If the overnight VAR dollar INR 95% confidence level is 50 paisa, the spot is 73. The meaning of this is, what is the worst price for a importer or exporter if the spot is 73 and tomorrow 95% I am sure that rate will go adverse only to the extent of 50 paisa. Or I can put it in the same another way. If the negative movement of paisa is only 50 paisa, 95%, I'm not 100% sure, 95% possibility is the amount will downside, the fluctuation will go adverse only 50 paisa. Today it is 73. Tomorrow maximum negative movement will be, adverse movement will be 50 paisa. In that rate case, what is the rate for an exporter? Exporter, higher the amount you get, more benefit. So it will be negative side. Today it is 73. Tomorrow for an exporter, maximum the rate can go adverse by 50 paisa, 72, 50. Importer, just the opposite. Today, if you want to buy, you can buy it 73. Tomorrow, what will be the rate? Maximum it can move adverse 50 paisa. Are you 100% sure? No. 95% confidence level, it is 50 paisa. Because this is done based on some calculations, which we will do. And this is a statistical tool. It is over a period of time. A period, this 95% and this 50 paisa, these are all will be working only for a defined period of level. And the defined confidence level is, one value of Z is there. We have to study 90, 95, 98, 99. This is given by the statisticians after so many workings. They have done some research, and so we will just understand or learn that value of Z for the purpose of calculation. Another two examples also we will see.
If it is 96 or 97, what will be the answer, sir?
That will not be. That is why I told you these are all the calculation done by scientific experts. They expect that the deviation, standard deviations will be much only at this level. 97 or 96 is not that much that a matter. That doesn't matter much. That is why they have done these fixed level. Questions also they will be asking only at this level, because it is an internationally accepted pattern. Because maybe 90 and 91 will not make much difference. Next point after 90 is only 95. So that's the standard deviation they have worked out like that. They will not ask any other thing than. Definitely, I assure you.
Okay, sir.
The point is they will not give you the value of Z. What is the standard deviation at this level that we have to learn by heart? That is the only thing.
Okay, sir. If it is 90%, is there any difference will be there in 50 paisa and all?
Definitely that will vary. 90 and 95 will, the 50 paisa variation will not be there.
Okay.
The calculation, even if it is 95% or 98%, the 50 paisa variation will be same. But the probability of the adverse movement more than 50 paisa will be more. You got it? Suppose I say 90% confidence level, adverse movement is 50 paisa. That means there is a 10% chance that it may move beyond 50. But here I say 99% the adverse movement is only 50, means there is only 1% chance the rate may move 50. So this 90 confidence level does not have any impact on this 50 paisa, but this confidence level has got a impact on deciding this 50 paisa. Now 50 paisa notionally I have calculated, but now we will be working out what is the value at risk. For calculation of this 50 paisa, this is required.
Okay.
But it, whatever be the confidence level, here in this example, it did not change.
Okay.
Even if it is, but
For
we will
exporter,
be
it's
calculating.
72.50.
Yes, both adverse. So lower the price, higher the loss. Importer, higher the price, higher the loss. Now we will do that three material, this theory that already you would have studied. Three types of approaches. Parametric approach, Monte Carlo, historical. Now we will go for only this, we will work out a problem so that you will be thorough. Actually, the formula is value at risk. We have to calculate is W into V into Z. W value will be given, V volatility, Z is the normal variables or standard deviation at defined confidence level. This they will be giving, they can give or they may not give, because some questions they told me that they are not giving this. So the only my humble request, we will not go for argument. We will study this four defined confidence level. 90%, 1.645, 1.96, 2.326, 2. These four figures learned by heart. If they give in the examination, it is well and good. We cannot now go for arguing that. So we will study that. Why they are not giving, I don't understand. They have to give it. But we cannot ask IABF if they are not giving the defined confidence level. But we require for a formula, we require WV is required. And formula for overnight, that is value at risk for over a period of time is overnight VAR into square root of time. Based on this formula, the answer will be, you see, a bank XYZ has an investment of 1 crore. 1 crore is a W value. The daily volatility is 2%. So V also is given. Compute VAR at 99% confidence level. Z is value of Z is given 2.576. Overnight VAR, weekly VAR, monthly VAR we have to calculate. Come on, overnight VAR is W into V into Z. That is 1 crore into 2% is 0.02. Z is 2.576. This is a easy mathematical thing. But here, most important is what you understand by this 5,15,200. What do you understand by the figure? For a stock of 1 crore, 1 day value at risk is 5,15,000 means, what do you understand by this? Can anybody tell me?
Adverse.
That much of
Maximum
amount
variation. That much of
of risk
loss.
we are carrying.
Oh, very good, very good. Yes. Tomorrow, what is the percent? 99%. The value can maximum go down by 5,15,200. But still there is a 1% chance that the value may exceed this. What about value at risk for a over period of 7 days? Square root of daily volatility is square root of 7. So 0.02 into 2.65 value Z is given 13 lakhs. So over a period of 7 days, 99% the value may deplete or go down by 13,65,200. So this will determine the collateral security, margin, so many things are there. And monthly VAR is square root of 30, 5.28, 28,23,000. Over a period of 1 month, 99% the value can go down by, today it is 1 crore. After 1 month, as per our calculations, it may maximum it will go by 28,23,000. Still, there is a 1% chance that it may exceed this. So this is how the VAR they ask in the examination. I think the risk management also would have done this, isn't it?
Sir, if they have not given a daily volatility instead of weekly volatility, then we will divide by something. Is it any
Yes, yes. You can work out. These are mathematics only, no? Because three values are there. They give you daily volatility and the period. You can work out if the square root period is to be given. So when daily volatility is given and period is given, you can work out the over a period of time. If they have given the validity over a period of time is given and square root time is given, you can find the daily value. Divide the square root time, you will get this. That's simple mathematics. Now these are all terminologies. We'll go to bond terminologies. What is a bond? It is a debt instrument. Coupon is the interest payable. Face value is the amount that you buy for every purchase. Maturity is the period for which duration. Then, my God, why?
Surya.
Some echo coming. Redemption is when you get the amount that you get on maturity. Market value is the price at which is traded in the market. Bond dynamics, this is the most important thing we have to study. The interest rate and the bond price are inversely related. I think the ABM it was there, no? Bond dynamics.
Yes, sir. Yes,
Ah,
sir.
Yes, sir.
already problems also would have been that, so you know about it, no problem. Already the exam also is over. Now, the current year calculation also, the importance you will know that is how the current year, I will explain more theory of it because the practical thing you know working. So I will explain more theory of it, how they will ask in the examination and all. I will explain. Current yield, let's calculate the current yield of a bond with face value 100, coupon 10%, market price. It is at par, it is at discount, it is at premium. So face value 100, 100, 100, coupon 10, 10, 10, market price. So the current yield is based on this formula. Current yield is equal to interest by market price. If current yield is given, interest is given, you can find market price. If market price and current yield is given, you can find the interest. Any out of these, any three, two is given, other third you can easily find out. So what is the implication of this? When you are buying at 90, how the current yield has gone up? Because even if you are given only 90, your return is on 100. That is why this is more. Current yield is more. Here you have paid 110 premium, but your return is 10% on face value, which is low. That is why yield has come down. This we call immediate return. Immediate return. If you have understood this, hope everybody has understood this, then we can go for how they will be asking in the examination. Because here you work out 100, 10 by 100 market price face value is the same. Your return is also on the face value. That's why 10% is a current yield. Here you have invested only 90, but your return is on 10% on 100. That is why it is more. Here you have invested 110, but your return is only on 100. So that is why it has come 9. Okay. Now the examination questions, they will be asking, if the current yield of a bond is more than the coupon. Look at this, if the current yield of a bond is more than the coupon, that means the bond is traded in the market at a discount
Premium.
or
Price.
Discount.
Discount. Sorry, I understood you. Just never be excited. Likewise, if the bond is traded in the market at a premium, the current yield will be dash than the coupon. Less than. This is how they ask in the examination. Next is, here the point is yield to maturity. Yield to maturity, this is a formula. They will not ask, but only for understanding purpose I have put it. I will share that. But here the examination, they will be asking, what is the difference between current yield and yield to maturity? In current yield EC, it takes into account only price at which you buy. It is a return on your immediate investment. It does not take into account what is a remaining period to maturity. Suppose here 10% bond is maturing 2025, 11% bond is maturing at 2030. Which to invest, how you will decide? Because if you go by 2025, you will get the money in advance. Here you will get only in 2030, but there is a reinvestment risk. Because at 2025, if the rate of interest comes down, it is reinvestment risk. But suppose you are going for 2030, you will get the money only after 5 more years from this period. So you will be affected by inflation. So you should require a calculation. So that currently it does not take into account that remaining period to maturity, and suppose the bond also can be redeemed at premium. So current the yield to maturity is nothing but it takes into account both the remaining period to maturity, after how many years the bond will mature, and also whether the bond is redeemed at a premium. So those two things are taken into account this formula. Here examination, they will not ask this. Examination, they will be asking only this. What are the conditions if you want to get YTM? You should hold the security till redemption, and without any break, continuously you should get the interest. Third, you should reinvest it into the market. This condition they will ask. Subject to these 3 conditions, you will realize or get the YTM. So this is always very important. So this is just a formula, that a problem I have worked out. I will share it. And the duration is a duration. I think duration also was in the risk management, isn't it? Hello?
Yes, sir. Yes, sir.
Duration. Okay. So,
Yes, sir.
okay. So duration, as you know, duration is how much time that you have to wait to get the present value. So when you get the present value, that will be breaking even. At that point of time, you will be totally free from the interest rate risk and the price risk. That will be matching. And this they will be asking. Duration is these are the things that you require. Duration is holding period for break even. Duration captures interest rate risk of a bond. It is a holding period. This they will ask in the examination. 1, 2, 3, 4, 5. These 5 sentences are very, very important. Not 5, these are all black things, very important. We'll repeat. Duration is a holding period of a bond to break even. Duration captures interest rate risk of the bond, very, very important. They will ask in the examination. The holding period at the end of which the holder is not affected by reinvestment risk and price risk. Because already you have, when you get the present value, you are compensated. And in a zero coupon bond, so many times they were asked in the examination, there is no, the remaining period, there is no reinvestment risk because there is no payment of interest. You buy something as 40 rupees, after 20 years, you get the 100, deep discounted. There is no reinvestment. So there is reinvestment risk is needed. Longer the duration, greater the price sensitivity of the bond. Because when the duration comes down, within that duration, you will get the present value. So you will get the maximum amount, which otherwise you will get if you wait for the full period. And this is duration, YTM are inversely related. Duration, higher the duration, the YTM you are getting more, duration will come down because you reinvest and you will be able to get more money. Larger the coupon rate, smaller the duration. Then,
Sir,
yes.
sir, 4th line incomplete, sir.
Which one? Duration of a zero coupon bond. Oh, right, that was correct. Duration of a zero coupon bond and its maturity, and the duration of a zero. I will tell. So duration of a zero is the Okay, thank you. Good observation. Zero coupon bond, duration of a zero coupon is period to maturity. If it is 20 years, 20 years is the duration. Okay. Here also same, because I go for editing, it goes, the changes happen. Thank you. This is a time value of money. Already this, you know, that you are familiar with that. This basis point valuation. This is one problem is there. That is question. A bond has a basis point value of 125. The yield of the bond is increased by 5 basis point. What is the profit or loss? Here as per the bond dynamics, the bond has increased. So naturally, the price should come down. It is a loss. So 0.1 is 1 basis point for 5 basis point. 5 into 125, 625. It's a text problem only. Simple thing only. You can also easily understand. And modified duration divided by 1 plus by yn. Very, very important. So they will give the figures, easily you can find out. And the entire thing we are doing because of this. We want to find out this. This one problem is enough. This is what they ask in the examination. What is the percentage? Because duration and modified duration we are studying only to find out what is the price change in your bond portfolio when a market price changes. It is for arriving at the bond price change. We are studying all the duration, modified duration, everything. Now we will work out last problem, this one. What is the percentage change in price of a bond with modified duration 2.72 if the interest rate market increases by 0.5%? As per the bond dynamics, if the interest rate increases, bond price should decrease. We know the bond dynamics. The formula is this: minus MD into percentage yield. Minus is given because to show the depict the inverse relationship. Here minus MD into percentage change, that is minus 2.72 into plus 0.5. It is plus 1.36 of market price. If the market is 100 rupees, can you tell me what if the market price is 100, what will be the revised market price if the market interest increases by 0.5? Can you tell me? 1.36, 100 minus 1.36, 98.64. Now same problem, if the market decreases by 0.5, what will be this? If it is decreases by 0.5, this will also be minus. Minus into minus is plus 1.36. So this will become 101.36. And this is the person who is making us study all these things. Frederick or Macaulay, who is the Canadian economist who studied this duration and gave us all the formula. And last slide is linear curve, that you need not bother about this, but I will explain this. Linear curve is convexity. What is convexity is, we studied that example, for a 0.5 change, plus or minus, the increase or decrease will be same. But actually, this increase or decrease, what the increase and decrease I mean is this 1.36. Now, if it is minus 1.5, the value will be plus 1.36. Same, 1.36 either up or down. This will be like this same amount only for a smaller change in the interest rate. That is it. If the interest rate is moving more than 6, instead of the same, it will be instead of actual 6, the price change will be 5.8. This is known as convexity. You need not bother about this. Just to study this sentence, that is enough. This is the only sentence they will ask. Modified duration is a first order derivative duration, and convexity is a second order derivative to duration. If you can study by heart, that is enough. But I am anyway sharing that convexity you can study. I will share that now that you have got. Afternoon, I will share. Okay, I will do it. I will definitely share that. No problem. Now, you got any doubt, you ask me. And afternoon, whatever is your doubt, and some as many as questions possible, we can discuss. I'm preparing questions.
Hello, sir. Actually, I was about to ask to show
Next
the
is
slide
our
18.
time is 5:30. 5:30. 5:30 to 7. And a full IB and treasury questions we will discuss. Okay.
Sir, slide number 18. Actually, I thought of asking, but it has been unshared actually.